The stock market has been bleeding for 4 straight weeks. The Nasdaq is officially in correction territory, down over 10% from its highs. But that's just the appetizer. Let's talk about gold, the ultimate safe haven asset for 5,000 years of human civilization. War breaks out? Buy gold. Inflation spikes? Buy gold. The government goes off the rails? Buy gold. Right now, we've got war, sticky inflation, and the looming shadow of an economic recession. It's the ultimate macroeconomic trifecta. By every textbook logic, gold prices should be going straight to the moon. Instead, it just suffered its worst week since 1983. A massive crash we haven't seen in over 40 years. When an asset collapses despite every macroeconomic tailwind working in its favor, that's not a market failure. That's the market screaming a truth you don't want to hear. The macro Ponzi scheme. Let's look at an average guy. We'll call him John. John brings home $5,000 a month, but spends $7,000, juggling the balance across 3 different credit cards. You ask him, "Can you keep this up?" He says, "No sweat. I'm getting a promotion next month. I'll pay it all off." 6 months go by. No promotion. But he still bought the new iPhone, renewed his premium gym membership, and kept eating out. He makes the minimum payments every month, convincing himself the wheels are still turning. Then, one day, the company announces layoffs. John's on the list. The income stops. But the bills don't. At this point, he only has 2 choices. Option A, keep kicking the can down the road. Take out personal loans, borrow from friends, and plug the immediate holes. He survives the short term, but compounding interest ensures the hole just gets deeper. In economics, this is called Ponzi finance. Option B, bite the bullet. Downsize the apartment, slash every non-essential expense, endure 3 years of misery, and deleverage. It hurts like hell, but he survives. Folks, zoom out and apply that exact scenario to an entire country. That's the United States today. During the 3 years of the pandemic, the U.S. pumped over $5 trillion of fiscal stimulus into the economy. Where did that money come from? The money printer. The national debt has skyrocketed to $36 trillion. Just this year alone, there's $10 trillion in maturing treasuries that need to be rolled over. Printing money is basically borrowing from the future, and the interest on that overdraft is inflation. And just as we're failing to get inflation under control, the Middle East explodes and oil prices spike. The 1973 Playbook and the gold collapse. It's exactly like that over-leveraged guy making his minimum payment right as the layoff notice hits. Sound familiar? We've seen this exact movie before in 1973. That October, Arab oil-producing nations imposed an embargo, and oil prices tripled in 4 months. We had lines wrapping around gas stations, and inflation skyrocketed from 3% to 12%. The Fed chose option B, biting the bullet. Paul Volcker hiked the federal funds rate to 20%. Mortgage rates hit 18%. Monthly payments doubled. The economy was essentially strangled to death. Unemployment hit 10.8%, and we endured a double-dip recession in 2 years. But it worked. Inflation was crushed, and the US dollar was saved. The cost? Deep economic scarring for an entire generation. Put the 1973 Playbook side by side with today. Massive money printing, sticky inflation, war erupting, an energy shock, and a central bank backed into a corner. It's a carbon copy. With that historical context, let's circle back to gold. Why the worst week in 40 years? On the surface, it's a violent reversal in interest rate expectations. Before the Middle East conflict blew up, the CME FedWatch tool showed the market pricing in a near 100% chance of rate cuts in 2026. The debate wasn't if they'd cut, but how many times. Then the war hit, and that pricing was absolutely obliterated within 72 hours. The logic is straightforward. A blockade in the Strait of Hormuz takes 15 million barrels of oil off the global market daily. Surging oil prices directly pump up the CPI, pouring gasoline on an inflation fire that's already burning hotter than the Fed's 2% target. Jerome Powell didn't mince words at the latest FOMC meeting. The original plan of multiple cuts in 2026 is dead. Now we're looking at maybe one cut at best. But Wall Street is even more bearish. Economists at Goldman Sachs and JP Morgan are already floating the idea that not only will there be zero cuts, but we might actually see rate hikes. Going from multiple cuts to potential hikes is a massive 180-degree pivot. Why does this crush gold? It comes down to real interest rates, nominal rates minus inflation expectations. Gold yields nothing. Its opportunity cost is the real interest rate. When real rates rise, holding gold becomes expensive, and capital flees to U.S. Treasuries. Simply put, if a Treasury bill pays you 5% and inflation is 3%, you're making a real return of 2%. Gold? It just sits there collecting dust. In this environment, capital votes with its feet. But that's just the surface level. The deeper reason triggers a much more unsettling historical memory. During the Middle East conflicts of the late 70s and early 80s, oil-producing nations needed massive amounts of cash to fund their war machines. Where did they get it? By dumping their gold reserves. OPEC nations were sitting on mountains of gold, and the war instantly turned them from buyers into aggressive sellers. A sudden flood of supply hit the market, crushing prices. Today, as investors watch the Middle East escalate, that exact same fear is resurfacing. For the last 2 years, global central banks have been hoarding gold like crazy. World Gold Council data shows net central bank purchases topped 1,000 tons in 2024. China's central bank bought for 18 straight months. Poland and India have been accelerating their buys. But if this war continues to widen, that trend could violently reverse. Warring nations need military funding. Funding requires cash, and the fastest way to get cash is liquidating reserve assets. Buyers become sellers. In a supply and demand model, this is a multiplier effect. Demand evaporates at the exact same time supply floods the market. The price shock is doubled. And there is a precedent for this. When Lehman Brothers collapsed in 2008 and the financial system was on the brink of annihilation, logic dictated that gold should have soared. Instead, gold tanked from around $1,000 to $680, a 30% haircut in just 2 months. The reason was simple: a total liquidity freeze. Hedge funds were facing margin calls. Investment banks desperately needed to shore up capital ratios. Every institution was in a mad dash for cash, treating gold as a giant ATM. It wasn't until the Fed fired up quantitative easing, QE, and started printing trillions that gold rebounded, rocketing from $681 to $1,900 by 2011. It nearly tripled in 3 years. So, a short-term collapse in gold is actually the market's most sensitive canary in the coal mine for a liquidity crisis. When that light flashes red, it doesn't mean gold is worthless. It means someone in the financial plumbing is so desperate for cash, they are liquidating their ultimate safe haven. Today's setup feels eerily similar to 2008. The rug is being pulled. There's nothing wrong with gold itself. The problem lies with the weak hands holding it. If gold is the symptom, oil is the disease. A month after the US strikes on Iran, Tehran's retaliation wasn't kinetic missiles. It was economic warfare. A calculated two-step move. Move 1. Blockade the Strait of Hormuz. This strait is the absolute jugular of the Persian Gulf. By deploying naval mines and fast-attack patrol boats, Iran has effectively severed this vital artery. The IEA is already calling this one of the largest supply disruptions in the history of global oil markets. Move 2. Targeted strikes on U.S. energy infrastructure in the Middle East. Oil fields, refineries, pipelines, storage facilities. This isn't traditional military combat. This is straight out of the art of war, attacking what the enemy must defend. Iran knows they can't beat the U.S. in a head-to-head military conflict. But America's soft underbelly is its economy. The economy's soft underbelly is the price of oil. And oil is the bedrock of all commodity prices. Factories burn it, 18-wheelers burn it, cargo ships burn it, commercial jets burn it. Fertilizer is a petroleum derivative. Plastic is a petroleum derivative. Almost everything you pull off a shelf at Walmart, from production to freight to refrigeration to stocking, has an embedded oil cost at every single stage. If oil goes up 10%, the operating cost of the entire economy can jump 3% to 5%. This pass-through effect isn't a theory. It's backed by mountains of empirical data. Gas prices stateside have already surged to the equivalent of nearly $8 a gallon. While some global markets have price controls, the raw import costs are surging. When the upstream producers can't eat the margins anymore, those costs get shoved right down the throat of the consumer. Oil isn't just a commodity. It is the base operating system of modern industrial civilization. Mess with oil, and you mess with everything. All of this pressure ultimately funnels down to the desk of one man, Jerome Powell. He isn't facing a dilemma, he's facing a checkmate. In economics, there's a nightmare scenario called stagflation, high inflation colliding with stagnant economic growth. It is the ultimate central bank boogeyman. Why? Because the Fed's two main weapons cancel each other out. Hiking rates crushes inflation, but the cost is tightening credit, killing investment, and destroying consumer demand.
With the economy already slowing down, slamming on the brakes could send us straight through the windshield into a brutal recession. On the flip side, cutting rates stimulates the economy, but it unleashes liquidity, inflates asset bubbles, and pours gas on inflation. With inflation already running hot, stepping on the gas pedal risks hyperinflationary chaos. Hike rates to kill inflation, but murder the economy. Cut rates to save the economy, but feed inflation. You have to grab one of the knives, and the other goes right into your own gut. And now we have a new wild card, AI. Silicon Valley tech titans are posting record-breaking profits, but they are slashing headcounts. Meta has done multiple rounds of layoffs, Google cut staff, Amazon is trimming the fat. Profits are up, but jobs are down. This creates a bizarre macroeconomic signal. The GDP data might look okay on paper, but the labor market is rotting underneath. Traditional economic indicators are completely diverging. Which dashboard does the Fed look at to steer the ship? Powell's recent pivot to maybe one cut translates from Fed speak into plain English as, "We have absolutely no idea what to do, so we're going to sit on our hands and pray." But doing nothing is a signal in itself. It tells the market, we don't have confidence. And Fed policy doesn't just impact America. The federal funds rate is the conductor's baton for global capital flows. When the Fed holds rates high, the strong dollar wrecks everything else. The yen, the euro, the yuan, and emerging market currencies all get crushed under its weight. Global central banks are collectively shoved into a corner, forced into a lose-lose situation. To make matters worse, Powell has a guillotine hanging over his head. His term as chair ends this May. The likely successor is Kevin Warsh, a former Fed governor during the 2008 crisis and a key pick by Trump. Trump's economic playbook is pretty straightforward. Low rates, a weak dollar to boost exports, pump the stock market, and keep voters happy. But this whole philosophy relies on one fatal assumption, that inflation is under control. If inflation is running over 5% and you still cut rates, what does that equal? It's like throwing a thick electric blanket on a patient with a 104-degree fever. It might feel cozy for a second, but you're going to cook them alive. That's exactly the lesson of the 1970s. Nixon's Fed chair, Arthur Burns, caved to political pressure and refused to hike rates aggressively. The result? Inflation spiraled from 5% up to an apocalyptic 14%. Ultimately, they had to bring in Paul Volcker to clean up the mess by jacking rates to 20% and driving the economy into back-to-back recessions. This collision between the political cycle and the economic cycle is the core of every debate about central bank independence. Powell represents kill inflation first. Warsh represents protect growth first. Who is right? Frankly, they might both be wrong. Because the brutal reality of stagflation is that there are no good options. You just have to pick the one that destroys less. Right now, with Warsh's confirmation tied up in legal hurdles, the exact timing of the handover is up in the air. But whether it happens in May or July, the moment that baton is passed, Fed policy signals are going to experience massive volatility. And if there's one thing the market hates more than bad news, it's uncertainty. Warren Buffett famously said, "Only when the tide goes out do you discover who's been swimming naked." Right now, the tide is rushing out at breakneck speed. Europe. The Russia-Ukraine conflict has already drained Europe of its economic resilience. Natural gas prices 10 times at the start of the war, sending industrial costs into the stratosphere. Germany's chemical and manufacturing sectors were decimated. Just as they were starting to stabilize, the Middle East blew up. Germany has logged 2 consecutive quarters of negative GDP growth. They are officially in a technical recession. The ECB is flip-flopping between hiking to fight inflation and cutting to save the economy. Europeans know stagflation all too well. In the 70s crisis, their unemployment rate spiked from 3% to 11%. That trauma is still burned into the DNA of European policymakers. Japan. The yen has blown past 160, hitting multi-decade lows. Japan is the 4th largest oil importer in the world. A surging US dollar combined with spiking oil prices means their import costs are getting hit with a double whammy. The Bank of Japan is in a textbook catch-22. If they hike rates, they risk popping their domestic real estate and stock market bubbles. If they don't, the yen stays in freefall, and imported inflation devours the purchasing power of their citizens. The catalyst for Japan's lost 3 decades was a paralyzed central bank after an asset bubble burst. That ghost is officially back.
The Middle East. As for Middle Eastern oil producers, sure, rising oil prices mean short-term profits. But if this war spirals completely out of control, remember that both sides of the Strait of Hormuz are lined with oil states. Saudi Arabia, the UAE, and Kuwait will see their export lifelines choked off too. Worse, the security premium for the entire Gulf region will go through the roof. Foreign capital will flee. Sovereign wealth funds will shrink. The very foundation of Saudi Arabia's trillion-dollar Vision 2030 economic transition plan could be shaken to its core. Emerging markets. They are ground zero. The Turkish lira is down over 80% in the last 5 years. The Argentine peso is practically toilet paper. The Nigerian naira lost 70% in a single year. What do these countries have in common? Massive piles of US dollar-denominated debt, heavy reliance on oil imports, and fragile foreign exchange reserves. A strong dollar is a triple tap to the chest. Debt servicing costs explode, import costs explode, and capital flight goes into overdrive. The 1997 Asian financial crisis is the blueprint here. The Fed started a rate hike cycle, hot money fled Southeast Asia, and the Thai baht, Indonesian rupiah, and South Korean won all collapsed. The dominoes fell one by one. When the castle catches fire, the moat boils. 3 key takeaways for investors. Let's connect the dots. Gold plummeting, stocks logging 4 straight weeks of losses, oil surging, the Fed flying blind, and global currencies buckling. These aren't isolated events, they are links in the exact same chain. I'll leave you with 3 key takeaways. 1. When safe havens stop acting like safe havens, that's your ultimate crisis siren. Gold crashing despite the trifecta of war, inflation, and recession means only one thing. We have entered the early stages of a liquidity panic. Investors don't want a hedge, they desperately want cash. 2 months before Lehman Brothers went under in 2008, gold dropped 30%. Everyone liquidated whatever wasn't nailed down just to get dollars. Then the Fed opened the floodgates, and gold 3 times over the next 3 years. There is often a brutal, terrifying period of darkness between the warning signal and the final outcome. 2. History doesn't always repeat, but it definitely rhymes. In the 1973 oil crisis, inflation plus war and an energy shock pushed rates to 20% and sparked a recession. But by 1982, we kicked off one of the greatest mega bull markets in U.S. history. In the 2008 subprime crisis, the global financial system nearly vaporized, and the S&P 500 got cut in half. That was followed by a decade-long bull run where the index 5 times. In the 2020 pandemic, the market tanked 35% in 2 months, then doubled in 18 months. The takeaway isn't, what goes down must come up. The takeaway is that when panic-driven liquidations crush asset prices far below their intrinsic value, mean reversion becomes a mathematical inevitability. But there's a brutal caveat. You have to be able to survive the darkness. Over-leveraged players get margin called right before dawn. 3. Your portfolio structure must match your time horizon. If you measure your investing in years, today's volatility is just noise. If you day trade, today's volatility is life or death. The logic of dollar-cost averaging, DCA, is actually at its most powerful in a bear market. You're accumulating more shares for the same amount of money. But that assumes you are buying high-quality assets, not garbage penny stocks or hyper-leveraged derivatives. When the U.S. market pulled back 20% in 2022, the capital that deployed at the bottom is up over 40% today. Those who bought the 35% pandemic crash in 2020 doubled their money in 2 years. Every single massive wealth transfer following a crisis obeys the exact same rule. Wealth moves from the panicked to the disciplined. Darkest before dawn isn't just a motivational cliche, it is a statistical fact validated by 200 years of financial history. But the prerequisite is simple. You have to be able to hold on to your torch when the lights go out.